Yeah, so anyway, so welcome to the second session for our topic. So it's going to be lesson 1B, and our next lesson is going to be on vector models. So CAPM is not very loaded. I think the question can be a little bit confusing sometimes to answer, but then it doesn't have like a lot of content to follow. And some of this theorem and also assumptions, they can be difficult to like swallow because when you think about them, sometimes they don't make sense, but you just have to accept them because this is what you learn. So if you are if you are in the business of proving things or disproving things, for now you can try to tell yourself to just accept these concepts as they are. Not necessarily accept, but know them so that you can answer question relating to CAPM. So anyway, again, we're gonna start on CAPM. So on CAPM, there are several assumptions that they make. So mainly three assumptions is that the first one is that all investors are mean optimizers, or they all want to invest efficiently. So and they all agree on the returns, variance, and covariances of assets, of returns of assets, and they all have the same. They all have a unique returns. I mean, like risk-free returns, right? So all this, okay, so basically all these investors, they are all going to try to invest their money all equally into fund F. Okay, so basically fund F is going to be efficient. So if you have like risk, so if you basically have like risky assets over there, so then this is your risky assets, and this is your risk-free rate, which all investors have. So they all would want to invest in this fund over here. So this is basically the concept, like the introduction of this chapter. In this fund over here, we're just gonna call it F, right? So basically F is efficient. So basically all this, okay, so basically all these investors, like they would want to invest in that asset. So another assumptions we can make is that the market is efficient. Is that the market is efficient. The market is efficient. I'm going to use capital M to refer to the market. So the market is efficient. So if the market is efficient, so it lies on the efficient frontier. So it basically lies on the efficient frontier. And if this is the case, basically this market M, the market portfolio M, is the same as F. So basically this market, so this portfolio F is the same as F because they are both efficient. So basically this is the introduction on CAPM. So I know it's a concept that is hard to swallow, but then you can just take it as it is for now. And then, but then in reality, so there are people who have actually came out and argued that this thing can be, like it can be disproven. So, but for now, we learn it as a fact, right? So when they ask you a question about the assumptions, so those are the assumptions that you will need to make. Did someone who want to ask a question? No one. So anyway, we move to capital market line. So the capital market line is actually the, so is the line that represents the efficient frontier. So is the efficient frontier line as described by one fund theorem. So this is important. So okay, and we know that this is what one fund theorem have described, right? So this one here is going to be your tangent portfolio, right? So this line will be called your efficient frontier. So this line, which is called the efficient frontier, you can also call it the capital market line. So in this chapter, we are basically going to refer to it as the capital market line, basically. So we say that M is efficient. We have already said this like up there. So M basically is going to lie on the line, like most probably over here. And this line also have another name. It can be called the capital market line, or actually it can be called the pricing line. So to find the returns of any asset or any portfolio, like to find a portfolio in the capital market line, you basically have to like compare the gradient. So again, so remember this one is going to be your risk-free rate. Here's going to be, so we're just going to call this a portfolio. So okay, or the market portfolio. So you're going to have your M RM, right? So to find any asset on this capital market line, you are basically going to say R. So this is your returns of the portfolio minus risk-free rate over the risk of this portfolio equals to the returns of the market minus the risk-free rate over the risk of the market. So as you can see, you can simplify this and then you can write it like this. You can write as the returns. You can say the returns. Your returns is going to be equals to risk-free rate plus this sigma returns of the market risk-free rate over sigma M. So you can basically simplify it a little bit further, and then you can say that's going to be equals to RF plus sigma plus K, right? So this thing here has a name. They call it MPR. Is it MPR? Market price of risk. Yes. So this thing is called the market price of risk. So if a question says find the market price of risk, this is what you need to find. So we're just gonna call it risk. I'm like K. Sorry, we're just gonna write K on again. I'm like in our case. So basically, the K tells you by how much. So now there is a relationship over here, right? So there is a relationship between the returns and its risk, right? So basically, this again, how can I explain this? So basically, K tells you by how much your returns should increase for every 1 unit increase of your risk, right? So if your risk increase by 1 unit, therefore your returns need to increase by K. So and let's say maybe your risk increases, right? So your risk, how can I say this? Okay, you have risk in your market price of risk. So let's say maybe your market price of risk increases by 1. Okay, let's say maybe your K is going to be equals to 0.03. So this is the same as 3%. So if your okay, so if again, so if the market price of risk increases by a unit, then your okay, then what? Then your returns need to increase by 3%. I'm not sure if that makes sense. actually, if your risk increased by a unit, then so basically your returns need to increase by that K, and in this case, the K is 3%. Any questions? So basically, K tells you by how much should your return increase for every unit increase of your risk. So it basically makes sense because whenever your risk increase, so should your returns. So we expect our K to be a positive number. So if it's negative, then then that asset is not good to invest in. But then if you want to know like how much so for every unit increase of risk, how much return are we also increasing, then we know that that is the market price of risk. So I've seen this question in one of the exam papers. They can ask it actually. They can basically ask you to like prove it. Not necessarily prove it, but to write what it simply means. And if that's the case, yeah, you can write it down. So anyway, I hope this makes sense. Let me see if I have any questions. Okay, before we can go further. So basically, your capital market line. So your capital market line, your capital market line gives you the relationship between returns and volatility of efficient so this is just for concepts to understand the concept of capital market line. So as you can see, there's a problem with this concept, just that it says nothing about assets that are not efficient. So we become clueless when the assets are not efficient. So what happens if the asset is not efficient and it does not lie on the capital market line? We know that not all assets will lie on the efficient frontier. So actually, it's quite rare for assets to lie on the efficient frontier, right? So in that case, we use the concept of capital market, of capital asset pricing model. I think I described it in a late time here. He says that so basically CAPM describe a relationship between a systematic risk and the expected return of an asset. So basically here you can learn how systematic risk. So last time on the capital market line, you learned about the relationship between returns and volatility of an efficient frontier. But now you are going to learn about the relationship of returns and systematic risk. And this is described by this formula. You can use this formula. So this formula is simply CAPM. If they say CAPM, just know that they refer to this formula. So this one is beta, market access return, basically, and then where beta will be the covariance of asset I and market over variance of the market. So basically, as you can see, there is a linear relationship between your returns as well as your covariance, right? And the line which we are going to use to describe CAPM is going to be called the security market line. Let's say security market line. So this one is basically a graphical representation of CAPM. Basically, so in CAPM, so like I said, most of the questions I find, they are basically proof-based questions. So I'm gonna do the proof. I don't think they are that difficult, but I think it's necessary that we can learn them together as well, so that if you have any questions or if there was a step which confuses you, you can ask me. So we already know that this equation over here is for CAPM. This is basically CAPM. So if they want okay, so if you try to remove this expectation, right, just to write the returns as they are, then you will have the returns of I minus risk-free rate plus not plus, going to be equals to beta of asset I of the market risk-free rate plus error. Sometimes they refer to the error as random noise. So if you meet a term called random noise, just know that they refer to the error. So basically, we already know that when you find the expectation, it gives you CAPM. So your expectation will give you CAPM. And we assume that the expectation of the error is going to be equal to 0. So anyway, to find the variance of covariance of the return I and the market. So basically, you just have to take this thing to the other side, and then you'll have covariance of RF beta. I'm going to simplify this thing. So risk-free rate is deterministic, so he's not probabilistic. So there is no relationship. So you're just going to have 0. So for beta, you only have one beta, so the beta will come out, and then you will have covariance of half of the market and the market. So I can just write it as their market L, right? And then you'll have beta of the market and risk-free rate, which is going to be 0 again. And then you're going to have and then you will have the covariance of the error and the market, which again is going to be 0. So basically, your thing over here, your covariance is going to be beta sigma squared m, right? So this is where beta comes from. So if so sometimes if they ask you to prove where beta comes from, so you can just make beta the subject of the equation. So this is the same as IM. So if they do ask, this is how you actually have to like prove it. There are other proofs they can ask you to do. So again, let's say maybe they want you to find the covariance the covariance of what? The covariance of the returns of I and the returns of I. So he's basically the returns of asset I. I mean, like the variance of returns of I. Okay, so far, do you guys understand? There is no question. I assume you understand. So you can stop me anyway, anytime actually. And then you can simplify this. You can write it like this. You can just say it's going to be equals to the correlation. I mean, like the covariance between two the deterministic things is going to be 0, this and this. And then you're going to have between this and any other thing actually is just going to be 0. So for this one over here, so let's start with the market because it's deterministic. So you're going to have the covariance. So you're going to have beta. You're going to have beta I squared variance of the market, right? And then you're going to have so the covariance of the market and the error. So we assume that the variance of the error and the market is going to be 0. So we're just going to put them 1, 0, right? So we're going to write zeros. So this means that we're going to be left with what? We're going to be left with the variance of the error. So sometimes they can ask you to like prove this. You can do this. So basically CAPM and factor models are not that much different. So if you guys have any questions for now, you can stop me and then I can answer your questions. No question. So anyway. So there's a question then. 12, I forgot where it come from. The table contains information based on an analysis of 2 shares. Assume that the risk-free rate is 7%. I'm not sure if you can see. It's not very visible. Okay. The risk-free rate is 7%, and the market return is 15%. Compute the expected return for each share and compare it to the expected return predicted by CAPM. Compute the expected return for each share, right? So I guess this is the question, compute. For each share, and then compare it with the expected return predicted by CAPM. And then determine whether each share is undervalued, overvalued, or properly valued. Outline an appropriate trading strategy for each of the shares, right? So you want to find like how much each asset cost. So this one, like you will have to find the returns. So how do you find the returns? So you have A and B. Oh, so here, A and B here. So you're gonna have the returns of A. We said the returns of A is gonna be the payoff of the asset minus the. So this is the EE. Okay, so this is the equation we had earlier on. So the price, so after a year, we expect the price to be 27 rand, and there's gonna be a dividend of 1 rand as well. So you're gonna have X1, your X1 over here is gonna be 28 rand. It's gonna be 28, right? Minus the price, it's gonna be 25. Is that 25? Yes, it is 25 over 25. And then you'll find the rate of return for A, and then you do the same for B. You're gonna have 17.5 minus 15 over 15. So 28, 25 over 25. So the rate of return is going to be 12%. So we have 12% for A, and then for B, we have how much? We have 16.7. 16, yeah, basically. Am I right? So so this one are the expected return of the share, right? So based on our calculation, because so this one is expected, right? So we're gonna have to put the expa up there to show that it's expected. So now they want you to use CAPM. So remember that CAPM is basically this for asset I minus you can say risk-free rate beta returns of the market minus the returns of risk-free rate. So for A, based on CAPM, A, you have risk-free rate. They said the risk-free rate is 7%. So you're going to have 7% plus beta. It's going to be 1. And then you're going to have returns of the market. It's 15% minus 7%. So basically, you will have 15%. So basically, you can see that there is a price difference. So from our expectation to our CAPM. So anyway, so this simply means that A is overpriced. Oh, no problem. So A is overpriced. This one of CAPM, if the value of CAPM was higher than our expected return, then we would say that if our value from CAPM was lower than this value, then we would say that that is underpriced. But now it's higher, so it is then it is overpriced. We can do the same for B. The risk rate is going to be 7% plus beta 1.2. Times 15% minus 7%.
So can I please quickly ask something about the X1 value in the rate of return?
Sorry?
So when you work out the actual rate of return for asset A and B,
Yeah.
For the x1 value where we had 28 and for A and 17.5 for B, I suppose there could be other additions to the x1 value, except for a dividend. But is it just common practice to just add any value you have at time 1 to get x1?
Again, so normally they would include the dividend and the shares because that's how much it will be valued at time 1. I'm not sure if they will give you any other values. I will try to find a question like that, or maybe you can just, tell me which other value do you think you should
I'm not
include.
sure. I just want like generally, would you just add any? I suppose it could be just a dividend, but would you just add any value that the stock would have at the time 1? Well,
Normally,
to the value of
so yeah, okay. So normally they would look at the returns. They will look at the returns of so they will look at the value of the share plus plus its own dividends.
Okay, now perfect. I'll bear it in mind. Thank you.
Okay, no problem. And also, even on chapter 9, when they look at payoffs, they look at the value of the share plus the dividend it paid for that period. So anyway, for B, it's here. So you can also hear me, né? B, you can see for B is gonna be how much it's gonna be 16.6. So basically these things, they are close enough. So you can say that it is appropriately valued. You can say that B is appropriately valued. Maybe they will want you to like this thing like is 17%. It's gonna be like 17%. If this is the case, you can see that they are almost the same. So the thing is gonna close soon. So before I continue with the next question, again, should we take a recess? We have almost passed 38 minutes. And we can come back at 22. So we can like take a 5 minutes break.